Hello. Today, we're going to talk with you and Alex about how Tangible Wealth Solutions can help you invest in oil and gas royalties as an approved replacement property for part of a 1031 exchange. But before we get into the details, we need to share with you and Alex these important disclosures. As an investor, you look for smart ways to strengthen your investment portfolio through diversification, protection from inflation, and solid risk-adjusted return. Investing in oil and gas royalties can provide the ability to diversify using a 1031 exchange while continuing to defer taxes. In the U.S., there are two types of land surface rights: real estate, land with a building or buildings on it, accompanied by the dependence on tenants for income and ongoing maintenance, and subsurface rights, commonly known as mineral or royalty rights. To be more specific, we're talking about natural resources, including oil and natural gas. Oil and gas mineral rights allows investors to look below the surface and think outside the brick and mortar box. Private royalty ownership has been around for over 150 years, but unless you were born into it, most of us have not had access to the mineral rights these fortunate landowners have been passing down for generations. Oil companies like Exxon and Shell want access to oil and gas reserves. They will pay the mineral owner for the right to drill and operate oil wells on his or her property and pay a percentage of the revenue produced from what's extracted. This revenue is called a royalty. Tangible Wealth Solutions gives clients the opportunity to 1031 exchange into these assets and earn monthly income from these royalties. Royalty owners do not invest in equipment or field operations. The oil company pays 100% of the drilling costs and assumes all risks and liabilities associated with the ongoing operation. Meanwhile, each month, you as the royalty owner receive ongoing mailbox money, your percent of the revenue generated from each well on your property. As with a traditional real estate, royalty owners receive a direct deed and title to their asset that is recorded and held on a county level. This is one of the many reasons why this asset qualifies for a 1031 exchange. Because royalties originate underground and are less tangible than traditional real estate, many investors are unaware that this asset class meets the like-kind test that all 1031 exchanges must pass. Let's take a closer look at why this is. In 1968, the IRS published a ruling that clarified Section 1031 of a 1954 Act. The ruling stated that real estate ownership interests, whether above or below the ground, meet the definition of like-kind exchange. Court rulings have since reaffirmed that oil and gas royalty and trusts qualify as like-kind to all other forms of real property. Several revenue and private letter rulings have further established the like-kind nature of royalties when exchanging out of traditional real estate. Although a new concept to many real estate investors, oil and gas royalties have played a very prominent role in 1031 exchanges during the past 20-plus years. Now let's look at some of the main advantages to consider with royalty ownership. 1. The transaction size flexibility. The 1031 exchange alternative allows you to customize your investment level, whether you need $100,000 or $5 million worth of replacement property. Our partners can help carve out the exact interest that fits your exchange. 2. There is also the potential for superior cash flow when compared to other passive real estate income properties. 3. No capital calls. Investors in oil and gas drilling programs or tenant in common offerings bear the risk of future capital costs. Royalty owners do not face this risk, and there's nothing to manage or maintain with mineral properties. 4. Investor independence. Owners of undivided interest in royalty properties are not locked in an ownership structure that links them to other investors in the same property. Each owner is free to exercise control over the holding period and the exit strategy that suits their individual investment objectives. 5. 15% of the royalty income is shielded from tax, regardless of carryover basis from the previous property. With real property, investors are able to use depreciation to offset some of the income received. With royalties, 15% of income is offset through depletion expense. 6. Portfolio diversification. Cash flow from multiple producing wells and undeveloped acreage for future production. You have the ability to own royalties in different states, with some being oil and others being natural gas. 7. The owner decides when to sell and can sell any time after acquiring the property. 8. These rights can be transferred to heirs relatively seamlessly, and the person inheriting these royalties does not need to step in and worry about managing, like they would if they inherited brick-and-mortar real estate. To learn more, call us at 720-996-1794 or visit tangiblewealthsolutions.com.